All right, folks, listen up. We're talking trading today. Trading is buying and selling things like stocks, bonds, or digital currencies. Think of it like a giant marketplace. Some people are buying, hoping the price goes up. Others are selling, maybe because they think the price will go down, or they just want to cash in their profits. It's all about making smart moves, understanding the game, and hopefully coming out ahead. This isn't just for the Wall Street wizards. Everyday people can get involved too. You just need the know-how. Now, why do people trade? Some trade to grow their money over time. Others are looking for quicker profits, trying to catch the daily ups and downs of the market. The key is to understand what you're doing before you dive in. Knowledge is power in this game. Always remember that. So, stay tuned because class is in session. All right, let's talk spot trading. This is the most straightforward way to trade. When you do a spot trade, you buy an asset like a stock or some gold and you pay the full price for it right then and there. Boom, it's yours. You own it outright. The price you pay in a spot trade is called the spot price. This is the current market price for that asset for immediate delivery. You can hold on to them hoping they go up in value or sell them later. The key here is immediate. The transaction happens more or less on the spot. It's clean, it's simple, and it's how many people start their trading journey. It's a solid foundation for many investment strategies. Now, let's switch gears and talk about margin trading. With margin trading, you're essentially borrowing money from your broker to make bigger trades. You put down a portion of the total value of the trade, called the margin, and the broker lends you the rest. This allows you to control a larger position than you could with your capital alone. If the stock price goes up, your profits are magnified because they're based on the total position, not just your initial investment, but hold your horses. Just as profits can be magnified, so can losses. Margin trading offers big potential, but it comes with big responsibilities and even bigger risks. Section 4, Spot versus Margin, the tale of two trading tapes. So we've got spot trading on one side and margin trading on the other. Let's put them head to head and see the main differences. The biggest one, the elephant in the room, is ownership and leverage. In spot trading, you own the asset 100%. You paid for it, it's yours. Simple. In margin trading, you don't fully own the asset with your own cash. You've borrowed to control it. You're using leverage, which is like using a financial crowbar to lift more than you normally could. For spot trading, you need the full amount of cash to buy the asset. For margin trading, you only need a fraction of the total value, the margin. This means you can control a larger position with less of your own money up front. But remember, bigger plays mean bigger potential swings, both up and down. With spot trading, your maximum loss is generally capped at your initial investment. With margin trading, because you've borrowed money, your losses can exceed your initial deposit. Spot trading is pretty straightforward. Margin trading involves interest payments on the borrowed funds. Section 5. Weighing your options, the upsides and downsides. Let's break down the pros and cons, starting with spot trading. The biggest pro, simplicity and full ownership. You buy it, you own it, it's easy to understand. Your risk is limited to your investment. You don't have to worry about margin calls or interest payments on loans. This makes it great for beginners or for long-term investors who want to build a portfolio of assets they truly own. However, spot trading has its limitations. The main one is that your potential profits are directly tied to the amount of capital you have. Now let's look at margin trading. The big allure here is increased buying power. Leverage. You can control a much larger position than your own capital would allow, but the downsides of margin trading are serious. Section 6. Real-world scenarios and the neutral scorecard. Let's paint a picture with some real-world examples. Imagine Sarah wants to buy 10 shares of a hot tech company, Future Gadgets Inc., trading at $100 per share. If Sarah uses spot trading, she needs $1,000, 10 shares times 100. She pays the $1,000 and the shares are hers. If Future Gadgets goes up to 120, her 10 shares are worth $1,200. She made a $200 profit on her $1,000 investment. Now let's say Mike also likes Future Gadgets Inc. he decides to use margin trading. His broker offers 2-to-1 leverage, meaning he only needs to put up 50% as margin. To control $1,000 worth of stock, 10 shares, Mike only needs to use $500 of his own money. The leverage cut both ways, hard.